We're talking life, money, and confident finance with Amanda Redman of Amanda Redman Financial Planning. And I think it's fair to say that we all know that Her Majesty's Revenue and Customs have come up with a number of bear pits, bear traps that can cause you all sorts of bother when you're trying to plan for your financial future. So we're going to talk through a few of those now. And the first one is that the more you earn, the more the amount that you can pay into your pension actually gets capped, and that can have some quite serious implications.
Yeah, it can be a challenge for high earners. So normally you can contribute up to £40,000 maximum per tax year into a pension if you are earning more than 40,000. But as your total income increases, the amount you're allowed to contribute to your pension reduces. And although that threshold has recently been increased by the Chancellor, it still means that for some people, they will only be able to contribute up to £4,000 a year into their pension, which is really very little amount at all.
Okay, so I mean, there's also rules about how much you can save into your pension across your entire lifetime as well that you have to take into account.
Yes, so this is a separate rule called the lifetime allowance. So the government sets a maximum value of pension that you are allowed to accumulate through your lifetime. And if it exceeds that threshold, then additional taxes are applied to the pension. So that is another thing to be aware of. To ensure that ideally you don't go over that threshold.
Okay, and that's set at £1 million at the moment.
It started at it was reduced to £1 million back in 2016, and it has been increasing with inflation every year. But that means it's about 1,073,000, but it will increase every year. But it's still not it used to be 1.8 million if we go back many years, but it has unfortunately been reduced over recent years.
So you need a bit of careful planning to work out how to manage all of that.
Yes, and understanding what the projected value of the pension will be in future rather than just what it is right now.
Now, another important benefit that a lot of people have in employment is death in service, which essentially means if you die while you're still working for your company, then your loved ones get a big payout. But there is a real danger that a lot of that money could end up going to the taxman instead.
Yeah, so on the one hand, it's great that so many companies still offer a death in service benefit, but it's really, really important that it's written into trust. And what that means is that if the money is paid out in the event of your death, then it gets paid into the trust. Your beneficiaries can then access the money from the trust rather than it coming into your estate. Because if it comes into your estate, eventually it may incur inheritance tax, which at the moment is 40%.
Right. So if you end up giving 40% of your death in service away, that's quite a big implication for your loved ones, isn't it?
Absolutely.
So obviously a lot of high earners are self-employed, and if you sell your company or shares that you've got in your company, that can also create some pretty big complications if the sums are very big.
Yes, indeed. So for business owners, it's really important that they have a clear exit strategy and start to plan the financial implications a few years out. So when you sell your company or shares within a company, the value can be subject to capital gains tax. Again, unfortunately, this is an area where the threshold has recently changed. So it's important to take financial planning advice in order to manage that capital gains tax as effectively as possible. There are ways of mitigating that capital gains tax, and there are other investment solutions that can help you do that. So clearly selling your business is such an important part of life and then retirement. It's so important to get financial advice.
I mean, all of these things together, they call it estate planning, don't they? And that's really the crucial thing, to make sure that when you get to that point, you hand over as much as you possibly can to the people you want to get it.
Yeah, definitely. So estate planning is something that tends to become more important to us as we get older. But that Roy Jenkins had a fantastic quote when he was Chancellor, in which he said that inheritance tax is a voluntary levy that is applied to people's estates, people who distrust their heirs more than they dislike the Inland Revenue. And what he meant by that is that it's perfectly legitimate to restructure your estate, to minimise the amount of inheritance tax you pay. But again, it can be complex, so it's best to take advice.
Absolutely. And if you've got all of those elements together, it's a real sort of jigsaw puzzle, isn't it?
It is, yeah. There's lots of considerations. But again, it's very useful and important to discuss it as a couple and as a family. Nowadays, as people are living longer, people are choosing to support their children financially whilst they're still alive rather than waiting until they've died before the children receive the money. So there are lots of different solutions that could meet somebody's individual circumstances for their family.
And so if you've got any or all of those concerns, then have a conversation with Amanda Redman of Amanda Redman Financial Planning. You can take a look at creating tax-efficient financial strategies that can support you and your personal goals. Amanda would be delighted to have a no obligation personal chat with you about your finances.